this is a crisis. Let's face it. The rule book of how things are done and how they're analyzed, we can just throw out. I had a research meeting this morning with my economic team, and we were talking about things central banks could do, and one of the comments from one of the analysts was, well, if the ECB were to suddenly buy like $50 billion worth of gold to force their currency down, that would draw attention and it could be a problem. And I said it doesn't matter if it draws attention anymore.
Right.
Everybody is just doing whatever they have to survive. And, I don't rule out anything at this point in terms of the craziness of what we're going to go through.
No, you can't. And because the central banks are telling us we shouldn't. Scott, a pleasure. Thank you very, very much.
Every 3 months since the year 2009, the private New York Federal Reserve's Investor Advisory Committee on Financial Markets convenes for a quarterly meeting around a long central table seating some 14 members, plus high-level ranking New York Fed staffers in the 10th floor conference room. New York Fed investor advisors usually move on and off the committee every 3 years or so. In any particular quarter's meeting, there will be private equity executives, investment management CIOs and CEOs, large macro-focused traders, and perhaps a pension fund manager or two. Many of these current New York Fed investment advisors are luminaries and well-known names on Wall Street and throughout this financialized economy. This is the current list of 14 members who serve in this quarterly forum of informal New York Fed discussions on financial, economic, and public policy issues, which help inform the New York Federal Reserve's president and senior management about the financial world ongoing. You may recognize current member names such as outspoken gold bull Ray Dalio of Bridgewater Associates, Paul Tudor Jones, who claimed mid-last year that gold was his favorite trade for the coming 12 to 24 months, Bill Ackman, David Rubenstein, and there's also a raging silver bull among them. The same voice that started this week's update has frank thoughts about silver now in early 2020 and through the end of this decade, possibly into the year 2030. Hello, this is James Anderson with SDBullion.com, and today we are covering thoughts expressed by a billionaire silver bullion bull. New York Fed advisor Scott Minard made headlines this week for public assertions he made not merely on a blog post he wrote on his firm's website, but also in a Wednesday interview he did this week on Bloomberg, while he and hundreds of other billionaires on paper were in Davos, Switzerland. Let's begin by reading his blog post this week entitled, Global Central Banks Fueling a Ponzi Market. Ultimately, investors will awaken to the rising tide of defaults and downgrades. One of the topics that I am focused on in Davos is the deterioration in the quality of the corporate bond market. Disturbing trend is that despite the rally in risk assets in the prior year, the number of defaults rose by approximately 50%, according to data compiled by JP Morgan. Additionally, the number of distressed exchanges increased by 400%. This correlates well with our observation that the number of idiosyncratic defaults has been increasing. Ultimately, markets will need to reprice for this rising risk with increased bond spreads relative to Treasury securities. However, that day of reckoning when spreads rise is being held off by the flood of central bank liquidity and international investors fleeing negative yields overseas. And let's not forget downgrade risks of BBBs. Today, 50% of the investment-grade market is rated BBB, and in 2007 it was 35%. More specifically, about 8% of the investment-grade market was BBB- in 2007, and today it is 15%. It has more than quintupled in size outstanding from $800 billion to $3.3 trillion. We expect 15 to 20% of BBBs to get downgraded to high yield in the next downgrade wave. This would equate to $500 to $660 billion and be the largest fall in angel volume on record, and would also swamp the high-yield market. Ultimately, we will reach a tipping point when investors will awaken to the rising tide of defaults and downgrades. The timing is hard to predict, but this reminds me a lot of the lead up to the 2001 and 2002 recession. The prolonged period of tight credit spreads experienced in the late 1990s lulled investors into unwittingly increasing risk at a time they should have been upgrading their portfolios. This brings to mind the famous observation by economist Hyman Minsky, who stated that stability is inherently destabilizing. That is to say that long periods of relative stability in risk assets causes investors to keep upping the risk during a long period of calm. Ultimately, this leads to what he called a Ponzi market, where the only reason investors keep adding to risk is the fear that prices will be higher tomorrow, or in the case of bonds, yields will be lower tomorrow. Daniel Kahneman observed this behavior in his own work when he identified that investors' fear of missing an opportunity induces them to buy when they should be selling. Even though the recession clearly has been put off until 2021 and perhaps 2022, in the lead up to the 2001 recession, credit deterioration started to be evidenced 3 years earlier in 1998 as defaults and credit spreads were widening. This would sound like good news for yield-starved investors, and I would agree. But patience will lead to bigger opportunities for disciplined investors who don't wander off into exotic asset classes or chase current returns. Later this week, while in Davos, Minard expressed thoughts about our over-financialized bubble economy legacy ongoing since the last time in early 1980 when gold bullion and the other three major precious metals peaked and accounted for then mostly Western investors losing faith in waning fiat Federal Reserve note purchasing power. Stay tuned through the end of this interview and listen to the way in which Minard unapologetically speaks about silver as his bullish bet this year. Finally, listen to what he says when he gets essentially asked to compare silver's potential future price reflected by palladium's current exponential price rise.
We're bookending two radically different comments. One from you to start the week,
right,
basically saying this market was like a Ponzi scheme.
Right.
And we end the week, middle of the week so far, with Bob Prince of Bridgewater saying it's the end of the boom-bust cycle as we know it.
Yeah, I find that really interesting because, first off, Bridgewater, the people there are very smart.
Smart money.
You know, look, if you take the history of the United States since the late 70s, I would call monetary policy a policy of bubble to bubble. For instance, you know, to save the economy after the stock market crash, right, the Fed cut rates and overinflated commercial real estate, and then we had to bail out the banks with the Resolution Trust Corporation. So then once things calmed down again, investors no longer thought that commercial real estate was safe, and they inflated the internet bubble to the wealth effect to keep the economy going. And then, of course, it went bust, and so then people didn't feel safe in stocks, so they started buying homes. And we played that out, and it bust. And so my attitude is when you look at the amount of leverage in corporate America and where we are today, you definitely are inflating a bubble here in credit.
Well, let's talk about the quote that you sent out to clients. A long note, I've read it. Here's a quote from it. The timing is hard to predict, but it reminds me a lot of the lead up to 2001 and 2002. Then you pointed out the term Ponzi scheme, where the only reason investors keep adding to risk is the fear that prices will be higher tomorrow.
Right.
With that in mind, you've made this call. Are you de-risking or are you staying long risk? What are you doing?
You know, I got to tell you something. We started de-risking back in 2018. And I can tell you that I was an investment genius in 2018. But when the Fed pivoted, you had to ask yourself a question. And I'm guided a lot by behavioral finance and the work of Danny Kahneman, who won the Nobel Prize. One of the biggest mistakes asset managers or asset allocators make is they try to do too many tactical trades. And so what Danny would say is, look 5 years into the future, what do you see coming? And don't change what you're doing to try to catch a tactical move. So, you know, and so in 2019, as an investment manager, I looked like an idiot because we've trailed a lot of other people who've basically just said, hey, you know, wave in corporate debt, wave in high yield, you know, let's go for it. And, you know, someday, you know, the music will stop. But
is the elasticity when the music stops something anyone can manage, including smaller investors listening on Bloomberg Radio, watching on Bloomberg TV? Is the elasticity or malleability of the system there so we can respond and react when we get that? Or is it a jump condition where it's going to be ugly?
Well, you know, one of my colleagues at Guggenheim likes to say that asset prices go up on an escalator and they come down.
Well, normal.
And
Absolutely.
They come down in an elevator,
yeah.
right? So the problem is, since nobody I know is smart enough to figure out when the music stops, you know, I think that's a really difficult thing for people to try to time. And, you know, here, as an example, if 2 days from now or early next week, there's an announcement from the Federal Reserve or in the Fed meeting on Wednesday that they're thinking about tapering the bill purchase program. Remember what happened when we talked about tapering QE in 2013? We didn't even need the act.
That was a taper tantrum, and this is going to be called the Minard tantrum.
Carry on. Is this QE then? James Goldman, Morgan Stanley, sat in your seat, said exactly the same thing.
Yeah,
Many people disagree with you, though.
Well, I mean, I got to tell you something. When I talk to people at the Fed and other believers that don't think this is QE, they say, oh, well, the Fed isn't buying longer-term duration assets to affect the shape of the term structure of interest rates. And my response to that is, look, I think the official name of QE is large-scale asset purchases, right? And this looks like large-scale.
Well, I spoke to Ken, and John, this is important. I spoke to Ken Rogoff 2 hours ago on a panel here at WEF, and he alluded definitely to what Mr. Minard's saying, the idea that, look, it's QE, it's not QE, doesn't matter. The fact is they're affecting the process, which changes the behavior of the market.
This debate's going nowhere, Scott. What I want to try and understand is, what is the risk of getting it wrong?
Well,
what's the risk of saying it's QE if it's not QE, and what's the risk of saying it's not QE when it is QE? Is this just a debate just to have behind closed doors, or does it actually matter?
I think whatever label we put on it, the consequences are the same. And that is that when you put liquidity into the system and you create money, which is what the central bank is doing, it doesn't matter what you buy. You could buy baseball cards, right? But that liquidity leaks out into other asset categories. And so you get inflated prices in other areas. And, you know, as I've talked about in the recent piece, corporate bonds. You know, with central banks in Europe and Asia running negative interest rates and the Fed pumping out liquidity, you know, it just, the incremental stretch for yield just keeps compressing risk assets.
John, I invested in baseball cards years ago. I failed. I bought Oil Can Boyd where I should have bought Lenny Dykstra.
Should have waited for the Fed to buy T-bills.
I want to get to
it's the baseball purchase program.
To John's question about the news you've made here, Scott Minard, about a Ponzi scheme. That assumes under Ponzi, under what we know of Bernie Madoff, there's someone ill out there. There's someone evil. There's someone bordering on civil or criminal violation. Who is that person within the Minard Ponzi scheme?
Look, well, I mean, I'm not so sure that when Hyman Minsky framed the comment about a Ponzi market, that he was thinking that there was some nefarious activity going on. It's more of an investor behavior which is being encouraged, if you want to find out.
By who?
By the Fed. Because we're just, you know, every time, look, there was a debate back in December, you know, do we have a Powell put, right? We do.
It was delivered, silver platter.
Yeah. So we're operating back in that mode again.
Before you go, we need a conviction trade. Big calls, made a lot of headlines.
Right.
Where do you put your money? What's the #1 conviction trade right now for you, 2020?
Silver.
Silver?
Silver?
Yeah.
Why not gold?
Because when you look at the relative values of silver and gold, silver today is about, let's say, 65% below its prior peak. Gold is getting very close to its prior peak.
Can it go exponential like we've seen in some of the non-precious metals?
I think there's a high probability of that.
We will end today's market update by going back to late 2011 to hear why New York Federal Reserve advisor Scott Minard was a 20-year bull on silver bullion back then, when the spot silver price had fallen from 50 to just over 32 fiat Federal Reserve notes per troy ounce.
But what about silver? Why silver, Mr. Scott Minard? He's Chief Investment Officer at Guggenheim Partners. He has more than $100 billion in assets under management. Come on, man.
Silver?
Yes, why silver?
Well, look, it's the way the story ends is this, right? We are carrying around in our pockets chits of paper. And in 20 years, we're going to be talking to our grandchildren. And we're going to say how we used to take these pieces of paper out and hand them to people, and they gave us things of value in exchange for them. And then our grandchildren are going to look at us incredulously and say, oh, Granddad, how stupid do you think I am? Everybody knows that paper money isn't worth anything.
You really believe that's going to happen in 20 years?
Yes. And so, like many were saying back in late 2011, even this now billionaire New York Fed investor advisor is still stating that later this decade and possibly into the next, a coming exponential silver price rise remains a high probability future event. That is all for this week's market update. If you enjoyed this content, be sure to give our video a thumbs up. If you're not subscribed to our channel, do that. And finally, be sure to hit the alert button so you don't miss these market updates as they come along. Give us your comments below. Let us know what topics you want to see more coverage on.